Bueno, vamos ya con la recta final de Forex Day. Me acaban de chivar que esté preparada porque algo importante va a pasar. No sé muy bien, pero a mí ya me están empezando a temblar las piernas. Y eso que las tengo cansadas de todo el día. Pero me han dicho, Susana, estate preparada para todo. Ya veremos qué ocurre. Bueno, la próxima ponente que se sube aquí al estrado es Carol Harmer. Lleva más de 30 años en esto de los mercados, en esto del trading. 30 años de experiencia como analista, como trader. Es sin duda una de las analistas más respetadas. Empezó su carrera como trader en divisas a los años 80 y desde entonces pues ha ido descubriendo día a día con su trabajo cómo con el análisis técnico incrementar las ganancias. Ha trabajado en distintos bancos, ocupando cargos directivos de primera línea en los más importantes y luego ha desarrollado su trabajo como trader y analista independiente. Ha colaborado y sigue colaborando de forma habitual en distintos medios como Reuters, Bloomberg o CNBC. Y en los próximos minutos nos va a dar una auténtica clase magistral. ¿Cómo conquistar las cartas gráficas? ¿Están ustedes preparados? ¿Seguro? Pues adelante, Carol, todo tuyo.
Good evening, and thank you very much for waiting behind to see me this evening. I'd like to start this presentation. It won't be a presentation as such, but what it will be, we'll be going through specific charts with you and looking to see where the market is going to next. Now, most of the time that I speak to people, I like it to be interactive, so that instead of having question and answers at the end, we do it during my talk to you. You've obviously had a lot of presentations today, and it's a lot to take in. This is why, at the end of the day, maybe you would like to also ask me some questions about things you've learnt during the day, and hopefully I will be able to answer those questions for you. Obviously, this is only about trading and looking at charts. If you've got any questions about any fundamental analysis, I am not the person to ask. So obviously, I have traded for very many years, and at the moment I co-manage a fund out of the Middle East. Also, I deal with private clients of how they would like to trade, and I talk to them on a daily basis about what the markets are doing. Moving swiftly on. Now, I think most people are obviously interested in what the euro is doing, but also the one important market is the sterling market. Does anybody look at the sterling market or is trading the sterling market at the moment? Yay. Okay. Oh, we'll have a look at it and then we can see exactly why it's done what it's done, what I expect it to do, and what it should do over the next few weeks going into the summer period. So if we call up the chart now, I know there's a lot of people that look at bar charts and candle charts. I'm going to do the candle charts for you. I never do any analysis with candle charts, but they're pretty pictures. They're red and green. You can easily see them of what days it's gone up and what days it's gone down. I don't normally use candlestick charts to do my analysis on. The reason I'm going to have them on today is the fact that they are easily visible between the green days and the red days. Okay, so let's have a look and see what I look at. When you're trading, what you should do is you should use as little analysis as studies that is possible. The reason for this is that there are now currently 450 studies using technical analysis. The idea is that you strip away all of the noise, the gump, whatever, and you just concentrate on price action and the relevant indicators to trade the markets with. Now, as you can see with sterling, if I draw this line on here, you can see it quite nicely in a little bit of a downtrend. Now, when the market broke up on Friday, okay, you can see that downtrend line, and you can see quite capable that we were trading lower and the market was being sold off, and any little bounce, you know, we were holding 160 quite nicely. And we were holding the support down at 167, as you can see, which is over here, on this bit here. There. Now when the market broke higher, which it did, when it broke higher, it was not the right time to be short of the market. And we had to flip our positions. Fundamentally, the market was going to trade higher. Technically, the market was going to trade higher. And our natural level to which the market gravitated, you can see the level over there on the May highs was at 170. Now, when you get to such a major chart level, you have to be aware of the fact that the big hedge funds and the banks are going to come in and they're going to be selling at these higher levels. Now, trading isn't rocket scientists. I'm assuming most of you are now what we call the retail traders. Is that correct? So you have to be aware, whether you believe in charts or you don't, you have to be aware of where the major levels are, because they are prevalent to what you are doing on a daily basis. And you can't ignore this. They're there, and they're there for a reason. Many years ago, when I very first started, I used to have the central banks come in and talk to me about chart levels. Now, we don't get the intervention that we used to have, obviously, with the central banks anymore. But there's still major levels, and you can't ignore them, otherwise you're going to lose your money, and you're not going to be trading anymore. So it's a real sad fact that 90 to 95% of the retail market will fail. Now, there has to be a reason for that, and I cannot believe that it is because most of you don't know how to trade. That isn't the case. I think what it is that we learned how to trade on the ground upwards, and I think these days anybody can open a retail platform and just trade, and they have no training, and they don't really know what they're doing. And this is one way of taking the emotion out of trading, is to trade on charts. Now, I know it's not flavour of the month and it's not cool to actually trade off of a chart, but you know, at the end of the day, we're all in it to make money. That's what trading's about. That's why we do it. So I don't mind how I get to my profit at the end of the month, as long as I get there. And this is one way that you will make money, by trading on charts. You will. The only time that you won't make money trading on charts, if you don't listen and you don't look at what they're doing and they're saying to you. Now, you're going to get a lot of people that will tell you things over the next X amount of months, whatever it is that you're around, that you should listen to all the fundamental data, all the information that comes out. It's not strictly true. The economic data that comes out is lagging, which means it's a month behind, which means the price is always right. Whether you believe it or not, it doesn't matter. The price is right. So how do we maximise our profits? Okay, let's just take the sterling. You can see that we're in a triangle there. It's quite blatant. There it is. There's your little triangle. But what you can also see is the fact that as we've moved higher towards that key resistance level that we created in May, the reason people are selling is because charts make patterns, and it's up to us to maximise the profit potential within those patterns. We have double tops, we have triple tops, we have everything, but at the moment the market is selling sterling any level up to 170. Now, there is another reason for doing that. One, it can create a double top pattern, which should push it down to 167 again. Two, if it doesn't make that topping pattern and we do break out, 170 is a very big psychological level. It really is. And markets are very psychological, believe me. So if it breaks out of that 170, so you're buying at 170 and a half. But if we buy at 170 and a half, the market will expect 174 to 175. Go with it. It will happen. The weekly charts are showing no reversal whatsoever. They look like they're going to keep on going. But even though you may think it will keep on going, at the moment, you're still not buying sterling at all, because there's too much outside pressure selling it at those higher levels. You're buying a break. Now, a lot of you think, why would I want to buy something that's traded higher? You know, why not buy it now? Why buy it above And that's the beauty of charts. Of course, logic tells you that to buy the market at 169.50 is better than buying it at 170.50. Your problem comes is that below 170, you have more of a chance of the market going lower, okay? It's the wrong time to buy. You need to buy the break. You need to buy once it's cleared that resistance area. You need to buy once that double top pattern is finished. You need to buy once the algo systems have taken out the first little bit of stops, normally about 25 to 30 pips. Once we get above there, that's when you can go in and buy. That's when the market is going to fly. Any questions? Please. Help me out. Yeah. Yes. Oh, two's great. Yeah, stand up. Hang on. I think somebody's coming over to you with a mic. Yay.
Funds. Hi.
Hi.
Why do you assume that hedge funds are going to sell when they reach the 170 reached in March, and don't assume that they're going to break through this level?
The reason that they sell, I mean, trading is trading. Doesn't matter who you are, whether it's you doing your 50p or a hedge fund doing its 500 million clip. Trading's trading. History will tell us that patterns follow the same sort of thing. History will repeat itself. And it's natural for hedge funds, and I do know a few of them, and I know what they're doing, because they tell me. But even if I didn't, you look at that chart and it's natural that you would be selling at that major psychological level. It's twofold. One, it's at 170, okay, and we all know that round numbers is a big psychological problem for the market. Two, it's that double top. Traders are not rocket scientists, okay? They may have been way back when there wasn't the information readily available now, but they want to make money, and this is not a hard way to make money, okay? So at the moment, they will keep a lid on that sterling below 170. And we all know what will happen once it breaks. So that's why we are selling at the moment. But flipping it very, very quickly. It's a good risk-reward trade. And we like risk-reward. If we can keep a 1-to-3 or a 1-to-4 ratio, we're always going to be in the money, okay? Because even our bad trades really don't have that much of a loss to compare what you can make on the upside. And your second question?
My second question is twofold.
Okay, it's three questions.
It's a second question, only a second question.
Okay.
You say that once the price breaks
Yes.
the previous high,
Yes.
we can...
You've got to give it a bit. It can't just break the previous high. It's got to actually really seriously go for it on the top side.
That is my question. Like, when do we know that they really...
But that's why I've given it 50 pips. That's why my order in to buy for the fund is at 170.5.
And we can use the 50p to go high, or we can sell and put a stop loss on a 50p.
You can do both. You can do both. At the moment, I've sold sterling, and I will watch it for the next week, or however long it takes, just to have a look. My natural stop and to buy it is at 170.5. That gets rid of your algo systems. They only work on a 25 to 30 pip ratio. Okay, that gets them out of the way and doesn't get you into a bad trade. If you're going to be buying at 170.10, you're going to lose money. Okay, don't wait. Let it break. Let it properly break.
Do we have to confirm the resistance?
Not really. You've confirmed it by breaking 170.5. Normally, markets don't go 50 pips above a previous top. 20, 30, yes. 50, not usually. Which is why we give it that 50 pips from this particular pattern that's forming.
Thank you.
No problems. Any other questions? Any other markets that anybody would like to look at? Stock markets, yes, they're still going higher. No, we're not seeing a turn in them just yet, but we live in hope, okay? Soon, maybe, but not at the moment. Yes?
I understand that I understand there is a psychological barrier, resistance in 170, but can you see that in the chart as well, or you just see the psychological component?
No, you can see it in the chart, because if you look at the chart, you can see it stopped there before, and it went down to 167. So there is a natural barrier there at the round numbers, 60, 70, 80. I always say also the 5, so that'd be 175, 180, 185. Normally, between those 00 and 5, not really. You don't really get the natural psychological resistances that you see at the round figures. 170 is a big level, and it's going to struggle to get through there.
I understand that, but my question is that if there is a pattern,
A double top.
the chart saying that there is a resistance at 170.
The pattern is there already. You can see it. Look. There's that little top at 170, and there's that little top at 169.95. So we already stopped there. Now what we need to see is, can we stay below that level? Can the market go into, not a bear market, it won't do that, but you could get it pulling back to its breakout point. I mean, don't forget, we've had that move from 168 to 170 in 2 days. In fact, it mainly did it on Thursday. So markets don't normally run away with themselves. There is this natural barrier, and we just look along to the previous high there, and that's why people came in. There were 2 reasons for the selling pressure. And if you look at the chart, what happened yesterday, you can see where it spiked up to that 169.95 and then came down again. You know, so you could see that there was a lot of selling going on at those higher levels, and we saw it trading. We saw the flows come in. We heard what was going on. So that's why markets have a natural resistance, which you can see by looking at a chart. Okay, but even if you didn't look at a chart, you still know 170 is a big level, and it's going to take some doing to break through it. Any other questions? Any other markets anybody would like to look at? The euro has been extremely boring, okay? It's been really not one to trade, and people have stayed out of the euro. Euro sterling has been quite volatile. Gold, oil, anything you want to look at, and we'll go through it. Gold, not a problem. Now, gold is one of my most favourite of markets. It's something that I've traded extensively in my career. And I really do enjoy trading gold. I find it quite therapeutic, actually, when everything else is going horribly wrong, to trade gold. Now, you can see, I'll draw it on for you because it's quite interesting. I mean, you all know about trends, and you're not sort of novice traders, are you? Yeah? No? Possibly? Okay. Now, if I put this onto a weekly chart, I think you'll be able to see it a bit better. Okay. So this is the state of play with gold, right? We couldn't break through 2,000. We stalled at around 18.5, 18. And we came down. You can see where the market based at 1180. Can you all see that? Which is the inverse or the reverse of what we're seeing in sterling. These are how these patterns work. Okay? So you could see that we made a base here last June. Okay? There it was. We tried it again and we couldn't get below here. So naturally buyers came back into the market. You're always going to find markets. Buyers will defend and sellers will defend a potential double top formation. They always will, because 9 times out of 10 or 8 times out of 10 they will make money in doing so. So it's a little trick of the trade, I suppose, that I'm trying to let you know. So you can see we're gold based and we went higher. Now if you look at the chart that I've got up in front of you, you can see where one of the bars here, and everyone thought, yeah, good week. and then the next week, not so much. Now that created a double top on the daily charts as well. So we naturally knew that if the market could not break 1400, again, round figures, psychological, couldn't break it, it could only go lower, which is what it's done. But the interesting thing about gold is on the downside, we couldn't get below this little bit here. Okay? It just couldn't break it. So that's why people were coming in again and buying gold at around the 1240, 1238 level. And we're looking for it now to test these two trend lines that intersect here. Now you can see on the weekly chart, there's such natural resistance up there at around the 1300. We know that when we trade gold. So we know there's going to be a natural flow of sellers coming into the market at these round numbers. But to emphasize it, you have these moving averages coming in. You have the two intersecting trend lines. So by definition, I know for a fact that there are a lot of sellers of gold up at 1300. Any questions on gold, please?
Yeah, about the bullish attack.
The bullies.
Bullish, sorry for my English.
That's fine. Sorry for my Spanish. You're doing far better than I am, trust me.
Okay, that's welcome. Well, there's about the first of all, bullish attack. When,
Yeah.
when you see is the first candle go down and the second go down again, but this is normally puts down and then go up. This is a biggest fish player in the market, you know. There is a black hand who attack about our interests. I mean, it's like it's a game, you know.
Well, yeah, of course trading is a game. Yes, it's always a game. I mean, but what you have to try and do is you have to have, it's like an army, you know, you have to have the odds stacked in your favour. So if I can point out a few little tricks of the trade that we do as private traders and in a hedge fund and at banks, because I've done all three. You know, I trade for myself, I trade for a hedge fund, spent many years trading for a bank. So you can point out the little tricks of the trade. You see, and don't let anybody tell you that you can't do it. You can. The only thing that will stop the retail trader making money is confidence. And it's your money. And that's what knocks you a little bit. But if you trade like this, your odds are in your favour. And even if you have to sit there for a few days, don't worry. Don't chase a position. You know, wait for the market to come back to you. Don't chase a market. You will lose money doing that. It's non-productive. But yes, you know, people do sit there and look at charts. I know it's not cool to say that you trade off charts, but you know, I don't mind as long as it makes money. I don't care. I'll trade off bottle tops if it makes money. Doesn't bother me. I just know that these do make you money because they take out the emotion of trading as well. Because you can sit back and you can see it unfold. You can actually sit and see what's going on. And once you find that the market talks to you, you've got a much better understanding of it, and it won't be playing it. You'll be playing the market, and it will be in your favour.
Another aspect is, for example, in euro, the dollar.
Euro dollar, been very quiet. Euro dollar.
Yeah, but also in gold, I see the same situation because I think this is Fibonacci.
Yep, I can put Fibonacci's. I didn't know how many of you actually looked at Fibonacci's, but I will. Yep, of course it is.
Yeah, but it's that because when Draghi say the tax go down, okay, and the euro say make poof go down, go up,
Go up.
then boom go down. What happened? Is that a Fibonacci attack? Is that technical? Is a technical situation?
It is, but you have different types of traders. You have traders who react on news, you know. And the thing is, when something comes out, and let's be fair, you know, European rate hike is not unheard of. It's been in the market for quite some time now. But when somebody actually comes out and says, hey, maybe in a few months we may think about possibly, you've got these news-orientated high-frequency traders who will just go in and buy the market on the basis of a rate hike and sell on the basis of a rate cut. That's what happens. Now, we'll have a look, we'll see what happened at the Fibonacci levels, but it isn't just Fibonacci that's driven that market. It is purely speculative at that point. What comes into play is the fact that there is no economic figure that I have seen in 32 years that has made a market stop at a resistance level. The reason it stops at a resistance level is because it is a resistance level. So even with these swings of the high frequency trader reacting gutly off the news, you've still got the people that are sitting there going, that's enough, no more. And they'll have orders in above the market to sell. I do it all the time, you know, because I don't want to sit there all day, every day, looking at a market. It's boring, you know, so I can put my orders in and I can go away. I did it with oil last week. Quite happy to be short of oil, unless it broke 103.60. My orders was executed at 103.75. I was like, oh, great, you know. And then it just went, and I couldn't get out of it. It was fantastic. But you don't have to sit there looking at it. The idea is to actually go in of a daytime, plot sounds a bit ominous, plan your daily strategy, or your strategy. It doesn't even have to be for the day. It can be for the week. As long as you know that at that point you're buying, that's your entry level. At that point, you're quite happy to take your profit. You can always go back in. Profit's a profit. You can always go back into the market. As long as you're willing to take that much out of it. And where you're wrong, where are you wrong? Most important, risk management. Where are you wrong? Once you've mastered that, you'll be fine. And you can apply whatever time frame that you use. So if you're a very short-term trader, you can apply what I'm showing you now on a weekly chart to a 5-minute chart. The rules are the same. The strategy is the same. It doesn't change. Okay? But you've got to master the strategy. And once you've done that, once you can actually look at that and go, okay, yeah, that's going up after that, you're fine. You will be fine. It's just getting to know what you're looking for, you know, and knowing what the other people are looking for. Trading's very, very isolated these days. I started my experience in trading on the life market. I don't know if anybody, I don't know if you've ever heard of the life market, but there were 3,000 of us all trading in different pits on open outcry, screaming, shouting, hollering, you know, and that's how you learn how to trade. You don't have that now. It's just you and your computer and whoever you're listening to, really, on CNBC. And if you're looking at CNBC or Reuters or Bloomberg, you're going to get 20 different views a day. 20. You know, it confuses me. And I've been a trader for 30 years. 30 years. And it confuses me. So I don't look at it. You know, I will not have it on. Unless I'm actually appearing on the program, it's off. Because I just find it confusing me. Because you start to question yourself, like, well, why am I the only one that wants to buy gold here? You know, maybe I'm wrong. And once you start doing that, and if I can do it after all these years, you know, you lot have no hope. So you have to sit back and ignore everything around you.
Thank you.
It's okay. Now, my laptop got stolen today, just out of interest. So I'm using somebody else's laptop, and I don't know how to work it. It's on Windows 8, which I don't use. Yes. Hang on, I think you need a little mic.
You are looking for a short, sorry.
Oh.
You are looking for a short trade on gold at 300?
I am. I am.
What would you...
I'm more likely to take my profit on gold there as well,
but
around 12.98.
But imagine that you are out of the market right now.
I'm long of gold at the moment. I bought gold, yes.
But yeah, well, my question is, what would be for you a stop level if you want to short at 1300?
1305. Now I can say that with complete confidence because as the market came down, 1305 was a major, 1305, 1304 was a major support level, and it kept bouncing off that all the time. So what acts as support on the downside will act as resistance on the top side. So there will be an awful lot of people selling gold, 1298, 1300, and they will put their stops above 1305. Now on the retail platform, I know because some of the retail guys I deal with, that's quite a long way away. So what you could do as a retail trader, 1301 and a half, get out and think again, okay? But play that from the short side unless it breaks 1305, okay? That would be the way.
Thanks.
Apparently I've got 5 minutes left. Wow, hasn't it gone quick? So let's have quick questions, or quicker. Does anybody want to see anything else quickly? Do you want to all have a look at the euro? Do you get depressed? Do you? Yes.
My question is if you consider if there are any techniques which are much better than others, and if you can compare them, like for example scalping or swing trading.
Oh, scalping, no. Definitely don't scalp, because you might as well flip a coin, heads or tails, buy or sell. No. Try and... Oh, it went down the hole there. Dear Lord. What you've got to do in trading, it's a battle of wits. It's a battle of you against the market, if you like. So what you're trying to do is you're trying to hedge yourself to give you better odds. Odds makes it sound like gambling. That isn't so. But it does, it's the same sort of principle. Make it like you have better advantages, better odds of getting into the right position. That's why you need to sit back from the market and actually pick out entry and exit points. It will give you a far better profit ratio than just blindly scalping. If it takes that little bit longer, and it will take longer to learn how to do that, far better, because you'll still be here in 5 years, whereas 90% of you won't be here in 5 years if you scalp. If you scalp a market, your stop losses are so tight. So say you're scalping for 20 pips, which I can't even comprehend, but supposing you do, your stop loss has got to be 3 ticks, 4 maximum. What's the point? It will move that in a heartbeat. So at least give yourself a better chance by standing back and waiting to enter at the correct levels. Whether you're buying or selling, it's irrelevant, okay? And you can do that in up markets, down markets, and sideways markets. And always remember, 75% of the time markets go sideways, so they're much easier to trade than trending markets, okay? Because you've got the defined support and resistance levels, and you just trade amongst them. And then you trade the break. It really is more simple than people think. It really, really is. The idea is to actually sit back and be objective about it and wait. And traders by nature are not patient people. And you have to be, sadly, it's a sad fact now, you have to be patient. And once you can do that, I'm sure all of you will do really, really well. Now I'm being told to really hurry up now. So, if there are no more questions, I hope you found this informative. It's not the presentation I was going to do to you today. That went with the thief that took my laptop. But hey, you know, I hope you've enjoyed it, and I hope you've enjoyed the show. I know I have. And thank you very much for coming.
Yes, one question.
One question.
Well, 2 questions.
Oh dear.
First is...
Here we go.
Finally, which is your favorite time frame? Is daily?
Daily and 60-minute.
And 1 hour, 60 minutes.
60 minutes. I never go shorter than a 60-minute. That's a personal thing, but I don't see the point. There isn't the value in going any less than that, because I aim to put on a trade for 2 to 3 days, or in the case of Friday, an hour. So.
And second question related to this one, this first one, have you ever compared, because I mean you have a lot of experience, have you ever compared both time frames, taking, for example, a long period of time, for example, 1 year? I mean, have you ever compared 1 year using 1 hour and 1 year using just daily? I mean, in terms of return on your equity?
No.
No? I mean, no. Do you have any idea which one would be better for you? Well,
it would. You should always position yourself on a daily chart. And once you have your core position, you can trade around that on the 60-minute. So supposing your thinking is that euro is going to go higher, you position yourself, and within the euro going higher, you're in and out, in and out, in and out. So although you are using two separate time frames, you're really incorporating them into one trading idea. Do you understand what I'm saying? If there's a big level on a 60-minute chart, if the 60-minute chart is overbought on the stochastics, you wouldn't sit there still with your long position. You'd say, that's enough for the moment, that's my target, I'm out of there, and you'd go back in and buy it. But you'd be buying it because your core thinking is that the market's going to carry on higher. So yeah, you trade in and out of a position. So I probably trade between 6 to 7 times a week. And that's both short and medium term. So I'm not in and out the market all day long. It's too much like hard work. Seriously, if you just sit back, and most of the traders that I've trained, retail, when they've applied this thinking, they've come back to me a year later and said, I'm still here, I've done it, I've cracked it. And that's great for somebody like me who wants to try and teach how to trade the most simplest way that I can possibly teach you. I think I've run out of time now for any other questions. But again, thank you all for coming. Okay, it's been really great being here. Okay, thank you.